The Titans are retreating. Their empires, once unshakable, well, they're shifting. But who is moving into the void they leave behind in Southeast Asia's vital oil fields? Are they saviors or maybe scavengers? Today on Meridian, we're dissecting a really high-stakes energy gamble. It's unfolding right now across Southeast Asia. We're going to unpack this surprising, kind of dramatic shift in who controls the region's energy future and what it means for everything from national security right through to economic wealth.
And what's truly compelling here, I think, what makes this feel like a real thriller, is that the answer just isn't clear-cut. We're witnessing the birth of this complex, often symbiotic, but, well, undeniably fragile energy ecosystem. It's a calculated trade-off, really, between immediate benefits and maybe the subtle creeping erosion of national control. You absolutely need to hear both sides of the story to get the full picture.
Yeah, definitely. And as we unravel this whole geopolitical and economic chess match, we want to know what stands out to why you. And hey, if you find this exploration as thrilling as we do, make sure to hit that like button and subscribe to Meridian. So let's set the scene a bit. Across Southeast Asia's, mature oil fields, there's this dramatic narrative playing out. We're calling it the Great Retreat. Global oil giants like ExxonMobil, Chevron, Hess, they're systematically pulling back from assets they've held for decades. Now, this isn't necessarily a sign of failure, right? Despite what you might first think, it's actually a deliberate global strategy. But why are they leaving? What's the real driver behind this massive exodus?
Well, it's really pure portfolio optimization. That's the bottom line. These supermajors, they're shedding older, more mature fields. Why? To chase higher returns and, importantly, lower carbon intensity somewhere else. Think the Permian Basin in the U.S., maybe some massive new discoveries or deep investments in carbon capture. For them, these Southeast Asian assets, they've sort of become liabilities. They require significant capital operational focus, stuff they'd rather deploy in new frontiers. So they're not failing, they're evolving. But they are leaving behind what you could call an incipient vacuum.
A vacuum? Okay. But one that's opening up massive opportunities, I imagine. Take ExxonMobil in Malaysia, for instance. They didn't just, walk away completely. They transferred operatorship of two critical production sharing contracts, PSCs. Those are the agreements, right? Governing how the fields operate offshore peninsular Malaysia. They transferred them to Petronas, Malaysia's national oil company. And this includes the iconic Tapas field. I mean, that's been producing since 1978. So ExxonMobil, they still retain a working interest, but they've shed this enormous operational burden and the cost that goes with it. It's a calculated move, freeing up capital, shifting focus to ventures like, as you said, the Permian, and even carbon capture initiatives, sometimes even in partnership with Petronas.
Exactly. And this isn't just a one-off thing. The American exodus is quite pronounced. You look at Chevron, they exited the Indonesia Deepwater Development Project, sold its stakes to Italy's Eni, their new focus in Indonesia. Lower carbon stuff like geothermal. It's a significant pivot. And Hess Corporation, wow. They divested their Indonesian assets Pangka Natuna A to Pertamina and Thailand's PTTTP and the price tag, a staggering US $1.3 billion. These aren't just random sales. This is absolutely a coherent global strategy playing out in real time. It's reshaping the whole energy map.
Okay, so if the Titans are retreating, who's stepping into this void? You mentioned a vacuum, but it's not staying empty, is it?
Oh, far from it. It's being eagerly, almost surgically, filled by this new class of independent oil and gas companies. Think UK-based EnQuest or Singapore-headquartered Jadestone Energy. We've sort of started calling them the smart scavengers. And look, it's not meant as a slight at all. It's really a description of their razor-sharp model. They target those mature assets the supermajors just don't want anymore. These are fields that promise, for them, fast payback, low capex, and reduced carbon intensity. They're secret. They leverage existing infrastructure, often these huge floating production, storage, and offloading vessels, FPSOs, that dramatically cuts down on new capital expenditure. It's actually a brilliant business model.
Right, so their secret weapon isn't just, shrewd business sense or low overheads. It's genuinely specialized expertise, isn't it? These companies, they bring proven late-life asset and FPSO management skills, often honed in really challenging basins like the North Sea. Their goal isn't really to find brand new fields, but more to optimize, enhance, and extend the life of the existing ones. They're basically turning what were liabilities for the majors into highly profitable ventures for themselves. It's almost like this niche market for aging, but still productive assets.
Precisely. And EnQuest's recent deal in Vietnam, it's the textbook case, a real coup, honestly. On July 10th, 2025, they completed their acquisition of Harbor Energy's Vietnam business. Now, the headline value was US $85.1 million. Sounds pretty substantial, right? But here's the shocker, the detail that really lands like a punch. The net cash consideration EnQuest actually paid, a remarkably low US $25.7 million. Yeah. That's after accounting for the cash flow the asset generated since the effective date. They secured a 53.125% interest and operatorship of the Chimsao and Dua fields in Block 12 Abiweo, added about 7.5 million barrels of proven and probable reserves, and immediately boosted their production by around 5,300 barrels of oil equivalent per day. These aren't minor assets either. These are strong anchor assets for EnQuest's whole strategic pivot into Southeast Asia.
Wow, okay. So they truly turned a liability into an immediate asset with, well, barely any cash outlay. That's quite something. Okay, let's unpack this a bit more. What we're really witnessing here is a sophisticated stratification of the entire industry. The supermajors are stepping back from the day-to-day grind in these mature fields. They're becoming effectively financiers for greenfield projects or just shifting focus to newer tech. They're shedding assets that, for them, are liabilities. But for these specialized independents, they're basically gold mines. It's this new symbiotic relationship emerging. But I can't help but wonder, is it also a potentially more fragile energy ecosystem?
Oh, it absolutely is. That's a key point. And while the supermajors are recalibrating, you've got the national oil companies, the NOCs of Southeast Asia. They are far from passive observers here. Think Petronas in Malaysia, Petrovietnam in Vietnam. They're transforming from, mere custodians of national resources into really agile, commercially driven, and increasingly diversified energy corporations. Their strategies are bold, absorbing mature assets, making these monumental pivots to gas and downstream businesses, forging new international partnerships. They're playing the game now.
Malaysia's Petronas is a fantastic example of this diversified powerhouse idea. Their upstream arm, Petronas Carigali, is actively taking over mature fields like those ExxonMobil PSCs we mentioned. Some of these are 40 years old. But that's just one part of their game. They're making this monumental pivot to natural gas. I mean, listen to this. A landmark 50.50 joint venture with Italy's Eni. It's targeting 500,000 barrels of oil equivalent per day, mostly gas, from 3 billion barrels of oil equivalent in reserves.
That's huge.
It is, and with an additional 10 billion barrel in exploration upside. This is a massive strategic wager on gas as the primary transition fuel for the region. And they're even pushing into biorefineries for sustainable aviation fuel, expanding EV charging stations. This ambition is backed by serious financial muscle, too. RM $320 billion, that's roughly US $73 billion in revenue for 2024. This isn't just an NOC, it's a global energy player in its own right.
And Indonesia's Pertamina, definitely a resurgent giant. They have this clear dual growth strategy: maximize value at upstream and building low-carbon businesses. Probably their most significant move recently was taking over the Rokan block, Indonesia's largest oil-producing block, from Chevron back in 2021. That was a powerful vote of confidence from the government, right? Signaling their ability to handle these large-scale operations. Plus, they're embarking on this really aggressive exploration campaign, including a massive 32,215-kilometer seismic survey, apparently the largest in Asia-Pacific in a decade, all aiming to hit a national goal of 12 billion standard cubic feet of gas per day by 2030. And they're thinking globally, too. They've got a new Dubai office actively pursuing blocks in the Middle East, like West Corner-1 in Iraq. They are seriously on the move.
Vietnam's Petrovietnam, though, seems to play a slightly different role, perhaps more pragmatic. Instead of fully taking over everything, they seem to be more about enabling new foreign investment. Their 15% non-operator stake in that EnQuest deal for Chimsao and Dua seems typical of this approach. They leverage foreign expertise for mature assets, avoiding the full operational and maybe financial burden themselves.
That makes sense.
Yeah, and the 2022 petroleum law, effective July 1, 2023, that's their key instrument here, making terms much more flexible, financially attractive. And the success was, well, vividly demonstrated with that Block 15.2 PSC, approved in a record 96 days. That sends a powerful signal to the international market, doesn't it? We're open for business, and we're fast. And we shouldn't forget the context here. Oil and gas contributes a massive 10–13% to Vietnam's GDP, supplies 35% of its electricity. This isn't just business. It's really a matter of national economic and energy security. Okay, so we've got supermajors retreating, these smart scavengers moving in, and the national champions rising to the challenge. But these shifts, they aren't just happening randomly. They're fundamentally shaped by, well, the new battlegrounds of policy. Each country's unique policies are becoming just as crucial as the geology itself, it seems. Governments are, surgically redesigning their rule books to attract very specific kinds of capital.
Absolutely. Vietnam, for instance, probably made the most decisive move with its 2022 petroleum law. That's their central policy instrument now. It offers significantly extended contract terms. We're talking up to 35 years for certain incentivized projects, and tiered tax incentives. These can drastically lower corporate income tax, increase cost recovery for specific types of investments. It also streamlines a lot of the bureaucratic processes. Local media actually celebrated that EnQuest deal as a successful landing of British capital directly because of these attractive investment returns. And that 96-day approval for Block 15-2 PSC, it clearly shows their commitment to making this new framework genuinely work in practice.
Right. Meanwhile, Malaysia, facing declining production from its older fields, seems to have opted for more, let's say, fiscal finesse instead of a complete legislative overhaul. Through Petronas, they offer this sophisticated menu of contract types. Their late-life assets, LLAPSC, that's specifically for brownfield sites, fields with 10 years or less of remaining life. It slashes petroleum income tax significantly, offers accelerated capital allowances, and here's the real game changer, I think. It allows companies to carry back losses from decommissioning against prior profits.
That's huge.
It is. That directly tackles a massive financial deterrent for anyone thinking about taking on an older field with big end-of-life costs. They also have the small field asset, SFA PSE, which uses a simpler gross production share model. These are really highly targeted incentives.
And then you have Indonesia. Back in 2017, they embarked on arguably the most radical policy shift with their gross split PSC model. They completely abolished the traditional cost recovery system for a direct gross split of revenue. Now, the initial industry response was, well, let's just say lukewarm.
Understatement, maybe.
Perhaps. But Indonesia showed pragmatism. They made crucial amendments. They introduced enhanced ministerial discretion, essentially removing a previous 5% cap on how much extra production split the government could grant. They added significant incentives for advanced production, like a 10% uplift for tertiary or enhanced oil recovery methods. And for fields transitioning from old contracts, the cumulative production history is even reset to 0. That's a big deal for calculating the split. These improvements really boosted project economics. Reportedly, they dropped the Roken Block's break-even price from around $34 down to a much more attractive $26 per barrel.
So what does this all mean for you, the investor, or maybe just the observer? It paints a picture of a fiercely competitive environment, not just between the companies vying for assets, but among the nations themselves. They're competing fiercely on their rulebooks. The country with the smartest, most tailored, and most adaptable policies is the one winning the investment needed to sustain production and secure its energy future. It's like a policy arms race. And this, friends, brings us right to the absolute heart of the matter, the core conflict, if you like, of this whole energy thriller, this strategic pivot, attracting specialized foreign operators from mature fields. It presents Southeast Asian nations with this fundamental dilemma, a really high-stakes gamble. Are they making a savvy strategic move? Offloading operational risk, ensuring production continues, securing their energy future. That's one way to see it. Or are they inadvertently selling off their energy sovereignty piece by piece, maybe to less stable players? Here's where it gets really interesting.
Look, from the saving narrative side, the benefits are pretty clear, they're compelling, and they're immediate. Governments are offloading immense financial burdens. We're talking huge capital expenditures for things like enhanced oil recovery projects and potential multi-billion-dollar liabilities for decommissioning down the line. That's a massive weight lifted straight off national budgets.
Okay, to your point.
And continued production, even from these mature fields, it generates steady taxes, supports local services. You mentioned Vietnam. The oil and gas sector is a driving force for their economy. It creates jobs, helps the trade balance, and crucially, these independents bring the exact specialized expertise needed to keep that oil and gas flowing, ensuring reliable supply. Remember, gas from these very fields supplies 35% of Vietnam's electricity. They are absolutely essential partners in managing the decline and maximizing what's left. Plus, diversifying your partners means moving away from maybe over-reliance on just a few powerful Western corporations. That could arguably increase a nation's soft power through a more competitive market.
Okay, but hold on a second. While those direct financial benefits are tangible, let's really push back on that saving narrative. Let's argue this a bit. There's a very real risk, isn't there, of revenue decline over the longer term. You look at Malaysia, their oil and gas revenue, it made up a hefty 40% of the national budget back in 2009. By 2021, it had plummeted to just 19.2%.
True, the percentage dropped.
That's a dramatic cut to national budgets. It impacts everything from infrastructure spending to social programs. That's a huge hit. And you talk about reliable supply. But what about creating a new, potentially more fragile dependency? Supermajors, okay, maybe they were inflexible sometimes, but they had exceptionally robust financial buffers, deep pockets against price volatility. These smaller independents, yes, they're nimble, but they are inherently more financially vulnerable, aren't they?
But they operate on tighter margins, yes.
So what happens in a sharp, sustained downturn in oil prices? Couldn't that mean premature project shutdowns, interruptions in supply, or even outright corporate failure? The host nations are effectively taking on the counterparty risk of a less resilient operator. That feels like a big risk.
But wait, the supermajors were shedding those assets anyway? You're sort of presenting a false choice there, aren't you? The alternative wasn't necessarily continued supermajor presence indefinitely. It was often potentially no production at all from those fields, and the full decommissioning liability falling directly onto the national government with no revenue stream to offset it. So isn't it more pragmatic to have continued production, some jobs, some revenue, even if it's from a smaller, specialized player? It's about making the best of a difficult, perhaps unavoidable situation.
Pragmatic. Or just pushing the risk down the road. Let's talk about geopolitical leverage. This feels massive to me. A contract with an ExxonMobil or a Chevron. It brings the implicit political and financial weight of a global superpower behind it, doesn't it? That kind of hard power backing, that subtle diplomatic clout. You just can't replicate that with smaller firms.
It's a different kind of leverage, certainly.
So is the efficiency you're talking about really worth losing that powerful, albeit unspoken, asset? Especially in times of regional instability. Imagine a geopolitical crisis brewing. Who would you rather have as a major partner operating on your shores? A smaller independent with maybe limited financial muscle, or a global giant, potentially with the backing of its home government? It feels like a trade-off of very different kinds of power and security.
That's a powerful point. I absolutely grant you that. The hard power dimension is real, but again, those giants are moving on regardless. These nations are adapting to a new reality, not necessarily choosing it wholesale. They're not necessarily losing influence entirely. Maybe they're gaining flexibility by building a more competitive marketplace with multiple types of partners. That diversity in partners, you could argue, provides a different kind of resilience, a different kind of security. They're trying to manage their resources for commercial viability and national energy security first and foremost, perhaps not relying on a few large corporations to also act as geopolitical proxies.
But the financial stability, or potential instability, of a smaller operator, that counterparty risk, it remains a constant nagging concern, surely. If one of these key independents fails, the host nation is left cleaning up the mess, potentially saddled with those very decommissioning liabilities they thought they had offloaded. It's still a high-stakes gamble with potentially billions on the line.
It is a gamble, yes, I agree. But perhaps it's a calculated one, born partly of necessity. They are trying to ensure their energy future by making what they have productive for as long as possible. They probably feel they can't afford to just let these valuable fields die off prematurely. And regardless of how you frame the current trade-offs, the future of energy in Southeast Asia seems inextricably linked to natural gas. It really looks like a key transition fuel for the entire region. That Petronas-Eni joint venture we talked about, with its overwhelmingly gas-focused targets, that's a massive indicator right there. Indonesia's IOG 4.0 strategy aims to dramatically increase national gas production. 12 billion standard cubic feet per day by 2030 is the goal. Even EnQuest's Vietnam deal, which was mostly about oil initially, has significant upside and undeveloped gas prospects that they absolutely plan to appraise. Gas is central.
And while gas is undeniably key, enhanced oil recovery EOR that feels like the technological wildcard that could truly reshape the future production profiles. It has the potential, at least theoretically, to unlock billions more barrels of oil from fields once considered pretty much depleted. It could transform those declining liabilities back into valuable, long-term sources of revenue and energy. Of course, it's complex, it's capital-intensive, it's highly dependent on the specific geology of each field.
Very so.
But the incentives are starting to appear, right? Like Indonesia's 10% uplift for EOR projects or Malaysia's investment allowances within their PSCs. And the ultimate win-win scenario here could be CO2 EOR, boosting oil production while simultaneously sequestering carbon dioxide. That's a potential double win for energy security and environmental goals.
Looking ahead then, maybe we can sketch out two dominant scenarios for how this new dependency model might evolve. Scenario A, let's call it the optimistic symbiotic evolution. In this version, the NOCs successfully become these diversified energy champions. They effectively leverage the nimble independence to maximize value from mature fields. You end up with a multi-layered, robust energy system. This is basically the saving scenario we discussed, where ideally all parties benefit.
Okay, but then there's scenario B, the potentially chilling fragile dependency. This is the downside playing out. The NOCs maybe struggle to fully adapt. The independents get hit hard by price crashes or maybe significant operational failures. That could lead to widespread project delays, operational interruptions, maybe even corporate bankruptcies among these key players. In this seizing scenario, the host governments are left holding the bag, stuck with liabilities, a fragmented sector, and a far less secure energy future than they hoped for. It's a very real danger, I think.
So for investors looking at this complex landscape, the focus really has to be on specialization and operational excellence, and on targeting those stable, well-tailored fiscal regimes like Malaysia's LLAPSC seems to be. Managing political and fiscal risk is absolutely paramount.
And for policymakers across the region, it seems it's all about refining and maybe critically stabilizing those tailored fiscal regimes. Predictability is key for investment. They also need to enhance their regulatory capacity to effectively manage this much more diverse landscape of operators and ensure really robust financial circuit breakers and decommissioning funds are truly in place and funded.
And finally, for corporate strategists, particularly at the NOCs, it's that constant balancing act, sovereign duties versus commercial discipline. And maybe for the supermajors who are leaving, it's about ensuring responsible handovers, perhaps through new kinds of partnerships, like that ExxonMobil and Petronas collaboration on carbon capture and storage. That could be a model.
Ultimately, it comes back to that core question. Are these nations trading hard power for soft power, security for efficiency? And will the flexibility of this new dependency, this new ecosystem, truly outweigh its inherent risks for their energy future? It's a massive gamble still playing out, and honestly, the stakes couldn't be higher. What do you think? What's the biggest risk or maybe the biggest opportunity in this evolving energy landscape? Let us know your thoughts down in the comments. If you want more insights like this exploration today, definitely hit that like button and subscribe to Meridian. Until next time, stay curious.
If you want more no-nonsense stories about power, money, and the systems behind them, subscribe to Meridian channel.